Welcome to the ARMR Report morning meeting. I'm Brett Rosenthal. We're going to get ourselves ready for the trading session. We do this every morning at the ARMR Report, and I'm sharing this with all of you today because it's kind of a follow-up to our Saturday morning discussion, which we call Stalking the Bear. Now, we've been stalking the bear market for the last couple of weeks. The risk monitor at the ARMR Report's been red since the beginning of December, okay? And so we come in this morning with the market gapping down more than 1%. And I thought I'd just share with you some thoughts and let you see how we get our trading day set up. So the ARMR Report's about managing capital and concerning ourselves more with managing risk first and capturing upside second, right? It's a three-stage process. All the research we do adds ideas to our whiteboard, not to our portfolio. That's step one and a mistake most people make. They do research, they find an idea they love, they go buy it, okay? We don't do that. We fill up our whiteboard with companies we want to own, and we use algorithms to determine when to add and subtract capital from the market, okay? And those algorithms are based primarily on 7 indexes that we follow. We look for confluence across those indexes to tell us when institutions are moving capital in and out of the market. When we see all indexes behaving the same way in a bullish manner, it means there's a footprint of the elephants and they're starting to stampede, and we're going to put capital to work. We go to our whiteboard, find our favorite names, add positions. We're doing that because it puts us on the right side of probabilities when reward is worth the risk. That's what I come in every day thinking. Are the trades that I'm making, whether they're day trades, swing trades, or investing ideas, am I putting myself on the right side of probabilities when reward is worth the risk? So how do you figure out probabilities? You use statistics, you use algorithms, right? And it shows you, hey, when this sets up, there's a high probability the market's going up, right? Or when this sets up, boy, the reward from here is not worth the risk of putting money to work. And that's what's been going on for the last X amount of months in this market. I say we're stalking the bear because the big indexes are up for the year, right? The S&P's up, NASDAQ's up, market's up, right? But right under the surface, right under the surface, there's a ripping away at the foundation. They're termites eating the foundation. And typically, the big indexes or the 5 or 6 names that are carrying the market in the last few months eventually succumb, and it drags the market down. Okay? Now, there could be a huge reversal today. The whole market could be up huge. I'm happy to chat with you again tomorrow and tell you how I've changed my approach. But as of now, and for the whole month of December, we are protecting capital, putting us in the proverbial catbird seat. When this selling is over, we're going to be able to take that capital, put it to work correctly and aggressively in the best names at prices we never thought we'd see only a couple months ago. That's the strategy. Then we try to ride those horses as long as we can. Okay, so this is how I run my personal capital. You have to make your own choices. I don't know your risk tolerance. I don't know your goals. I don't know what capital you're working with. Okay, so what I'm trying to do is share with you my approach. It's over 30 years of doing it to help make you a better steward of your own capital. Okay, if you're a person who's content with owning 100, 200, 300 stocks in their portfolio and telling me that 5 years from now you'll make money, you're not going to hear me argue, right? 80% of the time the market goes up. There's tons of people that are content buying and holding, and they don't care, or at least they tell me they don't care, when their market portfolio drops 50% on the way to a profit 5 years later. Okay, that doesn't work for me and my capital. So the ARMR Report is about protecting capital so we don't have to go through that. I read a very interesting piece from Kathy Wood this weekend. I retweeted it. Maybe some of you read it too. She's talking about 5 years from now and how great her portfolio is going to be and how much money she intends that she thinks she's going to make over that 5-year period. Now, as it just so happens, ARMR insiders can tell you that my whole whiteboard's full of innovator names. I completely agree with Kathy that the best place to put capital long-term are explosive growth innovator names. I'm sure she's going to be right 5 years from now. At some point in the next 5 years, that portfolio will go up a lot for her, I'm sure, just like it did in 2020. Okay? But at the ARMR report, I'm not comfortable with allowing my portfolio to drop more than 50% on the way to a 40% CAGR over the next 5 years, which is what she says. Okay? I'm not willing to do that. So I protect capital. So I come in this morning. These morning meetings are about what are we doing today? And this is a little bit more long-winded just to get everybody up to speed on what we do each morning, right around usually 8:30. This was 8:45. But what's the trading posture? Okay. And so what I like to do is I write this captain's log for you first. And it took a little longer for me today to figure out exactly what I wanted to say. Okay. So ARMR Insiders, you can always log in and read what I'm writing. Okay. So my trading posture, and I'm not going to read it off for you, but I'm going to talk to you about it. We captured mad alpha last week. We did it really on 2 days. We got long the market on Fed Day. I made a killing trading the triple index ETFs, TQQQ, SPXL. So we use the S&P and the NASDAQ, SPY and QQQ as our sources, but we execute the triples, okay? It allows us to create massive alpha over an hour or two, okay? We did it on Wednesday with the Fed, and we did it again on Friday. In an hour, we had a huge run, trading between spot gamma locations or ARMR PMP locations, which is our day trading algorithm, right? The price movement profiler is what I like to call it, okay? So we use our buy triggers, we use key locations, we capture upside, we get out. Every now and then I have some questions. Should we be holding this for a swing trade? And I keep saying no, this is not a swing trading market because the risk monitor's red. Investors Business Daily went green last week. And I came on here and I shared with you guys that while I totally respect the Investors Business Daily, okay, they completely missed what was going on last week. Last week was an OPEX week with a Fed meeting. So we went into a week with lots of puts because people were afraid what the Fed was going to say. Fed news comes out, puts get dumped because Friday's expiration, which leads to these quick rallies, okay, which masks the stealth bear market. People respond with, hey, the market was up big on Fed Day. Let's go buy the market, right? Even Investors Business Daily, right? Not everyone's right all the time. I love IBD. I'm not making fun of them, but everyone makes mistakes, okay? So now they've already switched back to uptrend under pressure. And if the market ends like it is starting today, there's no doubt there'll be risk monitor red tomorrow. Okay. So, oh my goodness, that coffee's good. All right. So what we saw last week was a microcosm of how options can control the market in a short period of time. And now what we get this week is a revealing of the true direction of the market. Now, look, if the market bottoms today and skyrockets into Christmas, hey, great. I'll have a risk monitor green. I'll come on here and tell you we're getting long the market. Okay. But as of right now, what the market's telling you and what it's been telling you since the beginning of December and what it's been telling you for a couple months, if you're looking anywhere other than the NASDAQ 100 and the S&P, is that there's a bear market going on. And it's not hard to understand. Let's strip out all the noise. I don't care about the new variant. Okay. I don't care about any of these other, like I'm reading this morning in headlines that market's down because Build Back Better is not going to get passed because of Joe Manchin. Ridiculous. This has got nothing to do with why the market's down. Okay. These are just excuses for people to dump who want to dump anyway. The market goes down, repeat after me, when the Fed reduces liquidity. The market goes up when the Fed adds liquidity. What I feel a lot of people have unfortunately experienced in 2021 is that they started investing maybe in 2019, 2018, 19, maybe 2020. Some people got started and they had a huge year, right? And they just assume everything goes up. And we had the meme stocks and we had cryptocurrencies and we had all of these things just go to the moon. So now everybody thinks that the market goes up all the time. But you see, the market went up because the Fed added massive liquidity, right? We made a fortune with everybody in 2020. March 2020, I came out and said, look, we got to buy with both hands. The Fed just announced they're buying corporate debt. I mean, it doesn't get more obvious than that, okay? So what's happening now is the Fed's reducing liquidity. Market's going lower until the Fed decides to change that plan. If the Fed comes out this week and says the variant has made us decide that we're going to delay our taper for a couple months, this market will rip higher into the end of the year. I'll be buying out like crazy, okay? But if the Fed doesn't say that, and I don't think they will, because that would make them look ridiculous, and because there's an inflation problem and they know it. So now the Fed's stuck between a rock and a hard place. We got whatever variant doing whatever it's going to do to slow down the economy, and yet the Fed has to taper and raise rates because of inflation. And that's a recipe for a bear market, period. Full stop. So when it comes to trading today and my posture, I'm going to look to make trades like we made last week, which were monster rallies. In a bear market, there are huge up days. So I search for those. We're going to use gamma locations, ARMR locations, ARMR buy triggers, look to put money to work. We'll do smaller position sizes early in the morning, or I might not trade early in the morning. Because when you get an open that's this ugly, what happens is it might rip higher for 15, 20 minutes and then implode again. So what I look for is a base over an hour, maybe an hour and a half, 2 hours. You'll see a base start to form that tells you the knee-jerk, not the knee-jerk, the impulse selling's over for the time being, which opens up the window for a Vanna rally. When not the knee-jerk, because that suggests it's not real. When the necessary selling takes a breather, puts get sold because guys who own puts are quick to sell their puts, and the market rips higher for a couple hours, could rip higher for a couple days. And that's the time for us to get in there and try to make some money capturing alpha. I don't see that happening in the first half hour. So I'll just, step aside and let it play out, then look for my opportunities. All right. Before I go, I just wanted to share with you this thought. You're going to see, and I'm going to go back over here to the captain's log. Okay. You're going to see a series of comments come out. You're going to read a lot of comments about how oscillators and put call ratios, okay, are telling you the market's bottoming right now. And what I want to submit to you is, it's kind of a strange thing. Any major sell-off comes with part and parcel oversold oscillators, massive, ridiculous, looks like crazy put call ratios, and they persist for a while. That's the nature of the beast. And what I hate about those type of posts that this is the bottom because there's an oscillator that's oversold or the put call ratio is crazy, so the market has to go up. It's so incorrect. Go back and look through history. Go back and look through any type of correction. What you get at the beginning of the correction is a massive oversold reading. That's what tells you the correction is starting. And then what happens is it'll bounce along the bottom, and it might have occasional blips out of oversold and roll back right over into oversold territory. Anybody who's been doing this a long time knows what I'm talking about. So I see this piece put out, and it really disturbs me. I'm going to try to blow it up for you a little bit. I don't know if I reposted it because I didn't want to. But there's the picture, okay? Options flow oscillator. This has got to be an unbelievable buy signal. Look at that. Look at, oh my God, it's all the way down here. It must be a buy signal. Okay, but look at the period in 2020. Right here, when it broke this line, was the beginning of a significant 5-week decline. Did it eventually go back up? And so therefore, being this far oversold was a buy signal? No. No, being this far oversold was simply because the market was cratering. And what made it a buy signal was the Fed started to buy corporate debt. And if you go back and look at these blips, they call them these green marks. But when you really see it touch this ridiculous oversold line, it's the beginning of a major decline. Look at 2018 right here. Look at what it did the next few weeks. It got wrecked before it reversed and eventually went up. It's complete and utter misdirection for someone to pitch to you that the market's oversold and it's time to buy. The market will always be oversold during a major sell-off. So don't be fooled by that. If we get a risk monitor green, we'll put money to work. And it will be true that the oscillators will be oversold. Do you see what I'm saying? It's not possible to have a correction with the oscillators overbought, is what I'm trying to tell you. Don't be fooled by that. An oscillator is not a buy signal. Now, I'll tell you when those things work. If we're risk monitor green and we're in an uptrend and the Fed's adding liquidity and we get oversold readings, they're great short-term buy signals because you're already in a major uptrend. That's when you buy the fucking dip, right? BTFD. That's when that works. But when you get into a real correction, those things won't do you any good. You need a solid buy trigger. What we use at the ARMR report are 7 indexes with their own separate algorithms designed for the volatility of each index and confluence across them. When we get that, we'll put capital to work. We're not going to call the bottom. I'm not going to get the bottom. The market will be up something by the time I buy it. I don't care. I want to protect my capital first, capture upside second, and I'll day trade indexes to capture alpha. That's what we'll be doing on this desk. All the ARMR insiders, I look forward to seeing you on the live trading desk. We'll get that started at 9:15. So we can map out exactly what our gamma locations are. This is the S&P, just real quick. So we went green here, risk monitor green, yellow right at the top, right? Red right here. And now we're going to challenge the lows of that, okay? Well, obviously, we're looking at this major top in the small cap index. And if we take out these lows, close down here, it's going to be ugly. Now, I will always share with you that what's really important to me is not Monday morning opens. Okay. So if we get a wicked reversal to the upside by the end of the day, I'm happy to be bearish. So please don't think that I just sit here and spew bearish behavior. I almost never do it. You know why? Because I want to be on the right side of probabilities. And 80% of the time the market goes up. So I'm not a perma bull, a bear. I'm not a perma bear. I can't wait to get bullish again. There are so many unbelievable quality names on the whiteboard getting destroyed. I can't wait to buy them because it's going to create massive wealth over the next 5 years, according to Kathy. And I think she's right. We just don't need to see our assets drop 50% to get there. Okay. So the end of the day is more important than the open. The end of the week is more important than the start of the week. Okay. So we can have a plunge lower, close higher by Thursday. I think it's a shortened week, holiday shortened week, right? So close higher by Thursday. And, who knows? Maybe I'll be happy to get bullish. But as we stand right now, it doesn't get more bearish than this from a fundamental standpoint and from a technical standpoint. Okay. And what we're going to do at the live trading desk is we're going to get to our day trading screens here. You can see all these charts. We're going to move these purple lines around, which are the spot gamma lines. And we're going to, when the market opens, all of the other lines will be formed after our opening range gets set up. Okay. So we're going to be trading, of course, the NASDAQ. And generally, I trade the NASDAQ and the small caps short. I never trade the S&P short. I'll never go short the S&P. So if I want to be short, I'll go short NASDAQ 100 and the small caps. If I want to be long, I'm generally long the S&P and the NASDAQ. Sometimes I'll get long the small cap index. Okay. So I'll see all of you over there in right around 9:15. It's 9:06 right now. Any quick questions I'll try to answer for you. So let's just see them up here. Greetings. Looks rough to start. Red sky in the morning. Sell or take warning. That's right. I love that. Jason, follow through day was a fraud. It's just, as I was saying on Saturday, William O'Neill just doesn't pay attention to options information. So he has and their strategy long-term is okay because 80% of the time the market goes up, right? So they're trying to catch every green signal they can. They don't care if they, make a couple mistakes. But obviously it would be good for the O'Neill as a company, I think, to start incorporating options data into their decisions because it's so clear. And I think maybe 5 years ago, it wasn't as important, but with every passing day, options information gets more and more relevant. So. Yeah, great. I just thought, what? Why don't we do some live morning meetings with all of you out there on YouTube? Maybe we'll do it the whole week. It's a holiday week. Let's just have some fun and chat for the next couple of days, just to give you a live look into what we do. Tops indices are in, lower end. Could be. We'll see. Like I said, I try not to predict what the market's going to do. I'm sharing with you what I see right now as it's happening. And then we read and react on our desk. The minute you start predicting, your ego gets in the way and you feel like, well, I can't come back on here tomorrow and tell everybody I think the market's going up because I said it's going down. So then you just fall down that rabbit hole. Okay. I'm going to keep it real at the ARMR report. I'm going to tell you exactly what I think and how I'm trading my assets. That's all. Sometimes I'm going to be right. Sometimes I'm going to be wrong. Okay. I'm going to cut my losses as fast as I can. I'm going to ride my winners and net worth's going to follow. That's the process of what I'm trying to do here. All right. Wonderful. I am glad you guys are enjoying. ARMR Insiders, anybody got a question for me? So Ares is looking at chart like Constellation Brands. So Ares, this is interesting. Ares is a long-time subscriber. In fact, Ares is the first ever subscriber to the ARMR report. So hats off to Ares. Love to have you. Love to work with you. You've brought a lot to the table, and I appreciate it. So I always listen to what thoughts you've got in your mind. So Constellation Brands breaking out. And we talked about this. Aflac doesn't look too bad, right? And Berkshire Hathaway. Miguel was sharing Berkshire Hathaway. That chart looks great. And so it brings to mind this thought that I know, Ares, you like to say, and I think sometimes it's, correct me if I'm wrong, quoting Jim Cramer, there's a bull market somewhere. We just have to find it. I don't subscribe to that belief. It's true there. But let me say this. There is a bull market somewhere, okay? But I just don't like to run my money that way. I believe in probabilities and statistics and getting on the right side of it. 7 out of 10 stocks follow the market. That's a fact. So there's a bull market somewhere is possible. I think in some market corrections, that's not true. Just look at 2020. So for about 6 weeks, there wasn't a bull market anywhere, and everything dropped something like 30 to 60%. So that's not always true. But for me, what is 100% true is 7 out of 10 stocks follow the market. So if I got risk monitor red and I'm putting money to work, I know that there's a 70% chance I'm going to lose money and only a 30% chance I'm going to make money. If we were to crunch the numbers over a long period of time, right? Obviously, we can make some good calls this time around and make some money. But I'm just saying over, 30 plus years of doing this, there are pockets of times we can get it right. But when I get on the right side of probability, the wrong side of probabilities, they work out like probabilities work out, which is it becomes very hard to make money in a market that's going down. So you can find some names that go up. Certainly we have some names in the portfolio. I mean, let's be honest, there is, when we look at our dividend portfolio, right? I mean, AbbVie's going, went to the moon. We bought it right here. AbbVie went straight up. I mean, we own shares of Pfizer. I mean, Pfizer's gone straight up. So obviously, I mean, and for things that haven't skyrocketed yet, but they're outperforming the market, you got IBM going up, off of the lows. You got Philip Morris going up off of the lows. So I don't disagree with you that there are places that you could put money right now. But for the way I like to run money, I would rather hold cash and day trade the indexes and wait for the next risk on and then own the names that I think have open-ended capabilities. That's just how I run, my personal capital. But I totally respect if others are moving capital into defensive areas and can make money that way. I never make money that way, but I do have that dividend portfolio set up. And I don't sell anything when it goes risk monitor red. I'm collecting yield. And what I find interesting is that whole portfolio is going up right now. So that's working. So I don't disagree with you. There are things out there you can do. Yeah. So Rob is discussing how, discussing the path of the Fed and what they're saying about tapering and then raising rates. I think, Rob, that if the Fed actually does all that, it's going to be a real ugly 2022. But I'll believe it when I see it. I think a lot of the time the Fed jawbones. So they're going to do some tapering, maybe raise rates a couple times and see what the market does. The market drops 30 or 40%. My guess is they're not going to go through with all that. So we'll just have to see how that plays out, I don't have any reason why FSM is up. I haven't checked, Chad, so I'm not sure why FSM is up for 14%. I don't know. I haven't seen that. Had its permit reissued. Okay, so ID Doc's telling us the permit's reissued. That's great. But I mean, that doesn't really change my interest in I'm not buying small cap mining companies in a market where the small cap index is plummeting. That just doesn't work for me. So coming out of this, I might start buying small cap silver stocks because silver goes up, maybe gold goes up, maybe as the market's going down. And then when the market's done plummeting and turns, we get a risk monitor green. I start buying the small cap mining stocks. I can see that, but I won't do that in the teeth of a sell-off. Okay. All right. Any other quick questions? And then we'll go. Quick comment. So, thank you. Appreciate it. That's my goal. All right, I think that's it. All right, so let's see, it's 9:15. So I got to hustle, get the live trading desk set up. I'll see you all there. Everybody else, have a great trading session. Don't forget to stay nimble, my friends. That's the key in a market like this. I'll see you on the flip side, everybody.